You keep hearing it everywhere. Wall Street went all in on Bitcoin. BlackRock's ETF changes everything. And yeah, the price went up. But do you really know what you're buying when you grab that shiny new Bitcoin ETF? Because I've looked into the filings, and what I found isn't what they are telling you on X. So, is this really the big win for crypto, or just another Wall Street trap dressed up as progress? Hey everyone, welcome back to Captain Allcoin. And today I can tell you guys, these still relatively new United States spot Bitcoin ETFs are a lot more complicated than the hype is trying to tell you. You probably heard that they are a game changer for crypto and maybe even saw Bitcoin shooting higher when they launched. But stick with me. I've been researching SEC filings and industry analysis, and the reality behind the scenes is very different from the headlines. In this video, I'll break down how these ETFs actually work, who really benefits, and why they might not automatically send Bitcoin to the moon. Let's start with the mechanics. A spot Bitcoin ETF is essentially a fund whose shares trade on stock exchanges but theoretically track the price of Bitcoin by holding real Bitcoin in custody. However, ordinary investors never touch the actual coins. Behind the scenes, only specialized players called authorized participants can create or redeem ETF shares by supplying or receiving Bitcoin. For example, BlackRock's iShares Bitcoin Trust Prospectus makes it clear. Baskets may be created or redeemed only by authorized participants. Each authorized participant must be in a position to transfer Bitcoin to and take delivery of Bitcoin from the Bitcoin custodian. In practice, these APs are big Wall Street firms and market makers like Jane Street, Goldman Sachs, Citigroup, Virtue, and others. And they have agreements with the fund. Only they can swap baskets of Bitcoin for ETF shares. You and I can buy and sell the ETF on the stock exchange like any stock, but we can force the fund to issue new shares or hand us Bitcoin. That job is reserved for the APs. If you're still watching and learning something new, do me a quick favor. Tap the like button so more people can see this. Also, make sure to subscribe and ring the bell. I've got more videos coming that cut through the noise and tell you what's really going in crypto. Okay, back to it. When the ETF needs more shares, say demand is high, an AP will deliver Bitcoin to the fund's custodian and receive a large block of new ETF shares, usually 5,000 to 40,000 shares at a time, called a basket. Likewise, if shares are in surplus, the AP can return a basket of shares and get the equivalent Bitcoin back. For BlackRock's ETF, authorized participants deposit Bitcoin via an approved market maker account and get shares. But get this. Other ETFs have different rules. ARK21 Shares Prospectus said their APs will only deliver cash for now, and the trust uses a designated liquidity provider, an affiliate of the custodian, to supply the actual Bitcoin behind the scenes. Fidelity's filing similarly notes that APs deliver cash to the trust, and the sponsor will arrange for the Bitcoin represented by the basket to be sold to satisfy redemptions. Trust custody. All the actual Bitcoin in these ETFs is held by big custodians like Coinbase Custody for Bitcoin and Bank of New York Mellon for cash. The prospectus for BlackRock's ETF even spells out Coinbase Custody is the Bitcoin custodian and Bank of New York Mellon is the cash custodian. In short, your ETF share is backed by real Bitcoin sitting in a vault or cold storage, but you don't own the keys. The ETF sponsor and custodians do. ETF issuers charge management fees. For example, Fidelity's Bitcoin fund charges 0.39% annually. There are also transactions fees when APs create or redeem shares. In BlackRock's case, the authorized participant pays a flat ETF servicing fee, plus any Bitcoin custodian fees for each order. BlackRock's affiliate Brill pockets a flat fee per transaction and reimburses Coinbase's custody fees. These costs ultimately come out of the fund's assets or are passed to APs. In other words, Bitcoin ETFs work like any commodity-backed ETF. They hold the asset in custody, and only qualified APs can exchange it for shares. The everyday investor just trades the shares on Nasdaq or New York Stock Exchange without touching any crypto wallet. Many crypto fans have treated these ETFs as a guaranteed rocket fuel for price, institutional adoption, and of crypto winter. To the moon. These clickbaity words have been flying around. But here's the reality check. ETFs don't magically print new Bitcoin or eliminate volatility. In fact, SEC filings themselves warn that Bitcoin is extremely volatile and ETF shares could lose all or substantially all of their value if Bitcoin crashes. The idea that an ETF alone will sustain a 100% rally is wishful thinking. The Bitcoin price did well in both 2024 and 2025 since the launch. But that doesn't mean the ETF was the sole reason, or that the rally will last forever. A lot of that momentum came from macro tailwinds, halving hype, and growing interest in AI and hard assets. ETFs may have helped by opening new doors for capital, but they also brought in short-term traders and institutions who don't think twice about dumping when the market turns. So, even though the price went up, it wasn't just thanks to the ETF, and it definitely doesn't mean we're in some guaranteed super cycle. The most recent example is the fact that Ethereum ETFs had a net inflow for 15 days in a row. And Ethereum price, it barely moved during this period. Yes, buying an ETF is easier for some people. As Reuters noted, it lets investors gain Bitcoin exposure without the complications and risks of owning Bitcoin directly. But that convenience comes with trade-offs. For instance, there have been several sudden ETF outflows when the market sentiment turned. Cointelegraph reported that US Bitcoin ETFs bled $278 million of outflows early as investor fear spiked. In fact, this happened many times since ETFs launched in 2024. In other words, just as money rushed in at times, it can rush out just as fast. Institutional analysts also caution that a spot ETF isn't an earth-shaking event by itself. For example, JP Morgan's team said a US spot Bitcoin ETF won't be the game changer the crypto community hopes for, meaning it's not a guarantee of perpetual new demand. And remember, Bitcoin's price is affected by global economics, regulations, miner selling, and etc. The ETF is another wrapper, not a change to a Bitcoin's fundamentals. After all, the total supply of Bitcoin is still capped at 21 million. The ETF doesn't change supply or halving schedules. In other words, don't assume an ETF means endless bull run. It's a new pathway for capital flow, but flows will depend on market conditions. Flows data so far have shown inflows and outflows with no guaranteed pattern. I can tell you that even CoinShares, a crypto investment firm, noted that Q1 in 2025 saw a net decline in ETF holdings, partly because the Bitcoin price fell, not because the world stopped wanting crypto. Let's talk about who makes money in this structure. It sure isn't just the retail buyer who thinks, yay, I finally have a risk-free way to own Bitcoin. The big winners are the legacy financial players, ETF issuers, custodians, and arbitragers. Companies like BlackRock, Fidelity, ARK21 shares, etc. will collect the management fees. For example, Fidelity gets 0.39% of assets per year, and BlackRock's iShares is likely in the 0.20 to 0.25% range. They haven't publicly filled in it yet, but it's low to compete. Those fees go straight to the sponsor as income. Authorized participants, market makers. These are big broker-dealers and trading firms. Jane Street, Virtue, Goldman, Citigroup, UBS, JP Morgan, Citadel, ABN AMRO, and others. They earn arbitrage profits by creating or redeeming shares when ETF price deviate from NAV, and they handle the logistics of moving Bitcoin. In BlackRock's case, APs also pay a flat transaction fee to a BlackRock affiliate for each creation. So the APs both pay fees and capture trading profits. A nice arrangement for big players. Custodians, Coinbase Custody and Bank of New York Mellon, or whoever is named, get new business to hold and secure vast amounts of Bitcoin and cash, often earning custody fees covered by sponsor. Coinbase, for instance, got the gig of being the Bitcoin custodian for the iShares Trust. Index providers, trust administrators. Even entities that provide the Bitcoin price index like CFI benchmarks or administer the trust can collect fees. The SEC filing noted service providers for index calculation, audit, administration, and etc. Who doesn't benefit so much? Well, you. The small investor, pay fees that get distributed up this chain, and you get only the ETF share, essentially an IOU that tracks Bitcoin. You don't get to decide when to hold or spend the coin or verify it on the blockchain. I've been seeing more and more people talking about something called paper Bitcoin, and honestly, it's a valid concern. When you buy a Bitcoin ETF, you think you own Bitcoin, but in reality, you just own a share of trust that holds Bitcoin. CryptoSlate warns that if people buy ETF shares instead of actual coins, we might see a gap between supply and demand and large financial entities controlling price discovery. To be fair, the ETF prospectuses do emphasize that each share is backed by Bitcoin. For example, BlackRock's filing explicitly says no shares are issued unless the Bitcoin custodian or prime broker has allocated to the trust account the corresponding amount of Bitcoin. So, on paper, every ETF share must correspond to real Bitcoin in the vault. However, the same filing also notes a subtle point. The trust will periodically sell Bitcoin to pay fees and expenses, meaning over time the amount of Bitcoin per share slowly shrinks. In plain English, they admit the fund will sell a bit of Bitcoin every quarter to cover the sponsor fee, which reduces how much coin backs each existing share. Plus, there's a still gap between owning an ETF share and owning a Bitcoin. If the SEC or the trust trustees ever froze redemptions, or if Coinbase got hacked, your ETF shares could become toxic even if Bitcoin itself is fine. True crypto and Bitcoin maximalists argue that not your keys, not your coins is a core principle, and ETFs put someone else in control of the keys. Remember, Bitcoin's fundamentals haven't changed. 21 million max, block rewards halving, proof of work security, and etc. The ETF is just a new wrapper on the asset. It doesn't make Bitcoin more decentralized, and it doesn't alter how mining or network functions. So, why aren't Bitcoin ETFs what you think? Because they are not a magic trick that pumps price without downside. They are complex financial products serving institutional and retail investors under a regulated system. The winners so far appear to be asset managers, banks, and custodians, not necessarily the person who just wants Bitcoin to go up. If you're bullish on Bitcoin for the long term, you may want to ask, do you really want your holdings managed by Wall Street and locked in an ETF, or would you prefer holding the coins yourself? The ETF offers convenience, but it also means giving up self-custody and paying extra fees. My bet is they are another tool in the box, helpful for some investors, but not a solution for Bitcoin's challenges. Keep your eyes open and read the fine print. The glowing headlines might fade, but the details in the filings never lie. Thanks for watching, and do me a favor and hit the like button. It really helps the channel. And if you're into videos like this one, make sure to subscribe and ring the bell so you don't miss the next video. I've got more crypto breakdowns coming your way, and I promise to keep it real every time. Until then, stay safe. This is Captain Allcoin, signing off.